Hi, everybody. Hi, Glenn. How are you?
Hi, Alex.
First of all, thank you so much for the opportunity. I know this was kind of a last-minute change. I was supposed to be in another panel, but I'm grateful to be here and to have the chance to have a great conversation with Glenn, who I admire greatly and who I think is an amazing resource and a great investor overall. So so I think we can start, Glenn, if you want to give us an overview of what you do, background, and the trajectory, that would be great.
Sure. Hello. Well, first of all, let me say that the reason I'm here is that I live in Puerto Rico now, and I work in Puerto Rico now, and I'm very fond of my new home and new office. And when I was asked to come here, I didn't know what relevance I could possibly bring, but I was delighted to do something for this conference. And as I thought about it, I thought, well, I do have 50 years of experience, which is more than almost anybody in my business, and I'm still running my business. So maybe I could, provide some information, some thoughts from my experience that might be of value to other people. And what I did as my supreme gift to all of you is that I condensed 50 years of information onto this. One little note card. So let me start by just saying, what do I do? For the last 40 years, I've run my own investment firm, and I'm the chief investment officer of those firms. We're long only, if you know what that means. Our clients are wealthy people for the most part, and a few institutions. And our approach is to own a dozen what we think are meaningfully undervalued good businesses. I have 4 associates, so we have a tiny staff. We're very research-oriented. And something a little different than other people, we invest 100% of our own money in the same portfolio that we invest in for our clients. So we definitely eat our own cooking. Sometimes I refer to us as an event-driven firm. And by that I mean when we do a trade, that's an event. The qualities we look for in these 12 stocks are, number one, are they cheap in relation to the cash flows that we think they're going to generate in the future? And if we're right about that, we're going to be in good shape in our investment. The second quality we look for is it an advantaged business? Does it have something about it that means that it's going to be able to prosper for a long period of time and not be devoured by the competition? So we're looking for advantaged businesses. And the third thing we look for is a management that has the best interests of shareholders and will not do stupid things with money. And unfortunately, there are empire builders who run public companies, and there are also people who are bored running their company because the business is going so great, it doesn't really excite them anymore, so they get a jollies by acquiring something else. And very often that turns out not to be so good for the shareholders. So that's what we do. What I'm going to say now is I'm going to talk about investment errors that people make, that I see them making. So I'm trying to inform you of what I see in that area. Then I'm going to tell you about a few things that you should think about. And this applies whether you're investing your own money or whether you hire a manager to manage your money. You should be hiring a manager that's thinking about the same principles that I'm going to talk to you about. And then finally, I'm going to make a bold prediction about the future.
That's the order.
First error I see all the time with investors is unrealistic expectations. So if you invested money at 10% for the time that I've had my own businesses, at the end of 40 years, you'd have 128 times your money at 10%. 128 times your money. And if you were able to be in that top 1/8% that could invest at 15%, you'd have 256 times your money. So that's the power of compounding, is that 15% or 10% for a long period of time will make you wealthy beyond anything that you could aspire to. if you were truly, truly at the very top and you compounded at 18%, you'd have 1,000 for one. But when you talk to people and say, you might earn 10%, they go, 10% on my money? No, that's because 10% seems so slow and it doesn't change things for me in the near term. So I think people are very unrealistic about what good investment returns could look like. So if you want to compound it 30%, 40%, or you think that that's what you should aim for, you're going to have to aim for investments that are highly speculative, and you're going to have to rely on a lot of luck. And it never works out.
That also has to do, I think, with people's long-term versus short-term approach. And I think people are very short-term natured in how they look at investments. And we see that on the private bank side. You're obviously very hyper-concentrated, and you have a very concentrated stock portfolio, which also is very interesting because you've had such a great long track record, but with an extremely concentrated portfolio of stocks, which is not necessarily, it's an anomaly because we usually, when you say highly concentrated portfolios, it's maybe 30, 40 stocks, and you've been able to condense that down to a dozen and still be able to make bold and good, reliable predictions year over year.
One of the things that's interesting, because sometimes people say, isn't that very risky to invest in a dozen stocks? And believe me, there were times when I invested in fewer than that. Actually, it's the opposite. You're going to do a lot more work and study things a lot more carefully, and you're going to pick a more conservative business. You're not going to go into a business that could fall on its face and collapse if you're going to put 10 or 15% of your clients' money in something. So it seems riskier, but actually it forces a discipline that if you're going to put a lot of your money in something, you're going to have to really understand it well, and you're going to have to have a high degree of confidence, and you're going to also have to pay a lot of attention to the valuation, what price you pay for it. You're going to have to
So usually how long do you keep these stocks? What's the
No, I would
turnover?
say some we've had for 10 years, and some it might, if we found out something very negative, we'd just sell it no matter when we bought it. And I would say the average stock is in our portfolio for 4 years. But it varies a lot. But point, Alex, which is the difference between investing and speculating. And I think the term investor gets used for everybody in both groups, but in fact, the two are completely different. And the difference is very, very obvious. There's a test. If you're deferring consumption for now and putting money aside with the idea of getting cash flows back from that investment, dividends, interest, whatever, then you're an investor. If you're buying things with the idea that you can guess whether the price is going to go up in the short term or down in the short term and betting on that, but they don't return any cash, and they never will, then you're speculating. And that's okay. Some people go to the horse track. You can speculate on stocks, futures, commodities, but that's not investing. So what I'm talking about is how you build wealth over a long period of time. And to that point, I once decided I want to find out how the Forbes 400 got rich. And the Forbes 400 almost all got rich by a business, a family business that was started and that was highly successful because it served clients' needs, and it grew and it grew, and the value of the business increased tremendously. And that's how they amassed huge wealth. If I look for the speculators in that group of Forbes 400, the stock traders or the speculators, sorry, I don't think I see any of them in there. So, I'm just telling the mistakes people make is they speculate on the price of something, and, it usually doesn't work out that you can repeat that. And so eventually you're going to get something very wrong and, lose all your money. Here's an interesting fact. Today, there are 3,700 publicly traded companies in the United States. Today, there are 27 million privately owned businesses in the United States. Now think about how most people think about the stocks they own. They're checking the price constantly. They're concerned if the price goes down. They're gleeful if the price goes up. It's sort of a natural tendency. But most businesses don't have a price. They're businesses. They provide a service, but they don't have a price for people to look at. And the people who run those businesses aren't going to some broker and checking out, well, what could I sell my business for every day? They're thinking about, how can I make the business grow? How can I serve my customers? And I think if you think of, most people don't think about stock investing like they're investing in a business, like they're owning a business. They think of it as a number, and up means good and down means bad. And if it goes down a lot, they get very nervous about it. And I think that's a big mistake, to think about businesses that you invest in, not as businesses, but as numbers. Market timing, huge mistake. You're not going to win. Maybe you'll win once, maybe you'll win twice, but eventually you're going to do poorly. And I don't think anybody can predict the market, even though that's all people talk about when they get together, is the market. They very seldom talk about anything substantial. And for that, I don't know if any of you are old enough to have heard of a money manager named Peter Lynch, but he was the greatest portfolio manager of the 1980s. He ran something called the Fidelity Magellan Fund, and he compounded people's money at 29% a year for 14 years that he ran that fund. Then he retired. 29% a year. Someone did a study of the investors in that fund over those years and found, to his surprise, that the average investor earned zero. Zero. How did that happen? Well, the assets of his fund expanded tremendously after he had 2 or 3 great years. And then after the market fell down, say the 4th year, everybody bailed out near the bottom. And then the fund would run back up again, and people would wait a year or two to see, when things were safe, and then they would put their money back in, and then the market would have its inevitable downturn.
But that's your typical behavioral finance issue that I think people don't think about it, but it's so prevalent in markets. And where we step in as private bankers is we try to educate our clients, because one of the mistakes is the typical, you buy high and sell low, when it's supposed to be exactly the other way around. But that also interplay of short-term investment versus long-term investments, and when to know and when to kind of take out the psychological and emotional aspect of investing, taking the emotions out of the numbers. And it's just a human behavioral thing. And for us as bankers and advisors, that's our role, to help coach our clients through the ups and the downs, and always trying to get them to stay clear of the noise and the news and the media and the meme stocks and the dinners with the friends and the next big shot deal, but always having the eye on the price and on the goal. And I think that's one of our biggest challenges as advisors, is trying to keep clients in their path and kind of saving them from themselves.
Yeah, Warren Buffett has said that when he passes away, his wife's going to end up owning a lot of Berkshire Hathaway stock. But his advice for someone would be, put 10% in cash, and then put the balance in index funds. And since there's no fees for index funds and no capital gains to speak of, it makes sense. But what would happen to most people who did that is that when the market's collapsing and the news headlines are horrific and the world looks very scary and they've lost half their money, they would bail out. I mean, there's just no question that most of those people would sell. And then there's a whole psychological game, because you sell, and you sell on the way down, and now you feel smart because it continues down. But then when it shoots up and nobody knows when,
you're scared.
And then it's suddenly above where you sold. Now you're, well, if it pulls back again to where I sold, I'll get in, but it doesn't. It keeps going up. And you waste 2 years, sitting on the sideline, kicking yourself for being an idiot. So that's what's wrong in a way. This is like not having an advisor. The problem is that you're going to behave like a human being, which is you're going to sell when you're scared and when you're afraid that your life savings going down the tubes, which is exactly the wrong thing to do. The other thing that Alex mentioned that is very important is actually the next thing on my list, which is turn off all the noise. The media, they understand that people are want to protect themselves against bad things happening, and we're all very attuned to problems, crises, situations which are difficult. And the emphasis in the news is always on the downside, an international crisis, whatever. In my 50 years in the business, there has always been a crisis, a problem, something
Every
to
week,
worry about.
there's something happening.
All the time. It's not today is like the worst. No, it's not the worst. And the people who trade off that news or off the news reports are going to be anxious, and they're going to be worried about the bad things happening, and they're not going to be able to withstand any downward pressure. And so the best thing is that is not relevant to the stock market. It might be relevant in the very near term, but the thing that's relevant in the longer term, which is what I was saying earlier, is buying companies that are going to generate cash and growing cash streams over time and become more valuable. And, so that's the last of my don't do things, is turn off.
Not do this.
The things I wanted to say in terms of investing is to think about your investments like a private business, like those 27 million people who own businesses where there's no stock price to focus on. Think about what are the qualities of this business and what is going to allow it to prosper for a long period of time. And those are going to be your winning investments. Forget about the hot stocks that everybody's talking about. Own things that you understand. Don't invest in things that you hear are great or that somebody said was whatever, but that you don't really have any way of knowing whether that's true or not, as opposed to businesses where you have some familiarity and can be on top of them a little bit. And I promised that I would make a prediction. And my prediction is that the last 20 or 25 years, many of you that may be your experience in business or in wealth, are anomalous. That they're non-recurring events in your lifetime. And by that I mean negative interest rates, hyper low interest rates, hyper low inflation despite really low unemployment, the appearance of 7 companies basically in the last 20 years that are now worth 30% of the whole market and that are worldwide franchises that everybody knows and that are just, they've never happened before. These kind of businesses grew up, and so many of them. And I would predict that in the rest of your life in working, that you are not going to have a repetition of those very unusual, anomalous circumstances. So if you're investing with the idea that the world is like it was the last 20 years and maybe it's going to continue exactly as it was, inflation's going to drop back to almost nothing and so forth, there's not going to be a recession. Yeah, I think you should think more carefully about that and go back and read some history books and see just how improbable and unpredictable those events were. So that's my big prediction. And Alex, do you want to talk a little bit about, things mistakes people make that you're aware
My
of?
side of the business.
Your side of the business.
Yes, of course. So for those who don't know, my name is Alex Valentín. I'm a private banker with JP Morgan. I was born and raised in Puerto Rico, and I lead our Puerto Rico vertical from Miami, but I go back and forth every month. My job, what it is and what we do in the private bank, I say we have 5 main pillars. So we do traditional banking, so checking, savings, credit cards, wealth management, so everything under the sun, brokerage, alternatives, structured products, private companies, credit. So not in Puerto Rico, but in the States, we can do mortgages, yachts, art, anything that is credit related, commercial lending, estate planning, and life insurance. So my role is like a financial concierge, one-stop shop for our clients. So we basically manage both sides of the balance sheet for our clients. And so my role is more of an advisor and banker. So my take on what you just said, I completely agree with everything that you said. And I kind of divided it between the mistakes we see on the investment side and then the behavioral side of things as well. So on the investing side, I would just add, and this is something that I covered Argentina, by the way, for many years before, and I think it translates very well into Puerto Rico because I see the same thing. Historically, there was an over concentration of Puerto Rico stocks or bonds. That's what people invested in. So opposite to diversification, which is what we always preach, Puerto Ricans always had a high degree of concentration in their portfolios, and we all know the story. We all know what happened. And I agree with everything else that you say, that chasing short-term returns, meme stocks, that crypto, all of that stuff. Today, I think we're living in a situation that had not been the case for many years because of negative interest rates and very low interest rate environment. Today, we're living quite the opposite, where we have very high interest rates, where your cash is yielding 5.5%, 6%. So I think one of the biggest mistakes our private clients are making today is that they're staying in cash for a long period of time. And that kind of goes against, okay, but what's your long-term approach? We always try to get clients to think about the long term and what their wealth will do for them in the long term. And then we invest those portfolios accordingly. So we'll have a short-term bucket, medium-term bucket, but then a very specific and strategic long-term plan that's tied to their goals. So I would say adding to that is not having an actual plan, just investing for the sake of investing and being in the markets. I think that's one of the biggest mistakes. And then on the behavioral side of things, and this is something that I think a lot of people maybe don't talk about, is the planning aspect of things. Teaching your children about wealth, teaching your children about your values when it comes to wealth, about your wishes. What is it that you want your wealth to do, not only for your generation, for their generation and perpetually? Charity, philanthropy, those are all things that in our job we try to entice clients to have those conversations, which are more the softer side of investing. Not necessarily, we're not talking about where you're going to put the next $100,000, but we're actually going to talk about, do you have life insurance? Do you have a trust? Do you have a will? Are your wishes going to be taken care of when you pass? Do you have a health directive? Like if something happens to you, is your family able to make decisions on your behalf? So all of those things I think are extremely important. And we deal with very high net worth individuals, and we see it all the time, where a patriarch dies, unfortunately, and it's chaos. It's pure chaos. And on the planning side, it wouldn't apply for kind of applies for Puerto Ricans, but the estate tax implications, it's a lot. It's 40%. And the amount of clients that we see that are extremely wealthy, that have very high net worths, and when we start talking about estate planning, they look at me and they're like, oh, we haven't done that. But they've been compounding their wealth, and things that we could have prevented 5-10 years ago, it's hard to do today because those valuations are already very elevated. So there's so many other aspects in addition to picking the right stock or not, or being in the market versus not. Sometimes that 40% of estate tax is the biggest drag on your generational wealth.
I was just enjoying that. I can't believe people don't do those things, really.
You'd be surprised.
No, well, so we've covered mistakes, both behavioral and behavioral. And if you have any questions, we have a few more minutes before we're going to be asked to vacate the stage. But I know Alex is willing to answer questions on almost any topic having to do with finance.
Yes, I can't see very well, but if anybody has any questions, feel free to. Go ahead.
Oh, sorry. I thought people could hear me without it. Hi. In your 50 years of experience, has there been a moment where it was just a lesson where you thought you had a good pick, but something happened that came out of nowhere, and maybe can you share that experience with us?
Yeah, the first thing that comes to mind was in October 1987. Stock market declined 23% in one day. That's why I say I've seen it all. Okay, 23% in one day. Many of the clients that I had were trusts, and many of the trustees called me up and said, "You've got to sell everything. You know, this is the beginning of the next depression." And there were charts that showed this is what stocks did at the beginning of in 1929, in October 1929, and this is, the charts fit exactly. And I'm the trustee here, and you're the manager, but I'm telling you, it's not a fiduciarily sound thing to do to hold stocks, given what's happened. And I don't know how old I was, like 40 maybe. And then trustees were a good deal older. But I always did what I thought was right, and I didn't think it was right to. We liked the stocks when they were 30% higher. To the idea of selling them just because they'd fallen in price, but the businesses were
Had
still
nothing to do with the actual business.
What? Nothing had changed. Well, yeah, maybe their contention was we were going into a depression. So, but I made up my mind. You said, what did I resolve? I made up my mind. I will never own a stock that's kind of a speculation, that's, kind of a not great quality, not the qualities I described to you. Maybe dipping down, sort of getting a little bit more speculative or less sound companies that I would want, if it happened again, that I'd want to be very comfortable with every stock that I owned and say, this is a solid business. This company is not going to go out of business. They're not financially struggling. They don't have high debt. They're well run. There's demand for what they do. So I made up my mind I will never own a speculative equity again. And I would also not ever be on margin, because they sort of say, if you don't need margin because you're so smart, then why have it? And if you're not that smart, it'll kill you. So you're going to get rich. If you're a decent investor, you're going to get rich with time. But if you're not a decent investor, that margin will sink you completely.
In your prediction of the next, 25, 50 years, that the world is going to be different, how does, for a typical investor, if that scenario were to become true, how would that change your views in terms of portfolio construction, right? If would you still be doing just stocks, like a hyper-concentrated stock portfolio? Would you be adding other but risk profiles, credit, some stuff that we haven't thought about yet, or just stay in cash? How does that scenario change the world from a portfolio construction point of view?
Okay. We don't think so much about portfolio construction as stock selection. Okay, so if a business flourished because inflation was really low and was going to do poorly with higher interest rates or higher inflation, obviously that would not be a stock we would, select. But there's always businesses that benefit by whatever the circumstances are. So for example, most basic kind of industries, pedestrian type companies, not the great growth stocks, they had a hard time when inflation was 1%. You could not raise prices in this country. And a lot of them had the kind of slow growing businesses, and they couldn't raise prices, so they got very little revenue growth. So, there wasn't much earnings growth there, which so they were not very exciting for investors because that was the environment they're in. Now you take a less good business that I'm talking about, not a bad business, but just less good, and you put it into a context of maybe 3 or 4% inflation instead of 1 or 2, and that has very salutary effects on the bottom line. And a lot of that changes just with psychology. I'll give you an example. A couple of years ago, I guess it must have been 20 or 21, in the midst of the pandemic, people were not going to work, and gasoline sales were down 20%. And gasoline station owners were used to the fact that they couldn't raise price because the guy across the street had a certain price. If you were a penny higher, nobody would come to your gas station. But when your volumes go down 20%, you raise price. So they raised price. What they found out was they made tons of money. They had a record year, even though they sold 20% less gasoline. And that goes into your head as a businessman. You go, wow, I didn't know how, I'm going to get my share of business, but if I get it at 5% higher price, I can afford to have fewer customers, but I'm going to make a whole lot more money. And that whole way of viewing things had gone away for 15, 20, 25 years. And now, once you unleash that, and they see the power of price and realize that they can take price increase, that changes how you would invest. I don't know if that's too elliptical as an example of how changes in something like that could cause you to look at different industries than the ones that you would have looked at when inflation was essentially zero.
I have a question for you. Talking about the succession and the planning and the behavioral side of things, I know you have several children. Have any of them expressed any interest in continuing the work that you've been doing for so long? Or what's, I guess, the plan for the business to?
Yeah, one of them is very keen. Only one is very keen. I have 7 children, and only one is very keen to follow my footsteps, and he's 12. He's 12.
He has a bit of a runway.
My dad was a famous baseball player, and the worst thing in the world for me to do would be to try to follow in his footsteps. And I'm not saying I'm on my father's league in baseball, because he was a Hall of Famer, but it's not necessarily a great thing for kids to follow their parents if their parents are truly, outstanding in the field, because, there's regression to the mean, and circumstances can be different, and expectations might make it very difficult for a child to follow in a parent footsteps. So I haven't pushed it or encouraged it or discouraged, but my 12-year-old, he wants it.
He's first in line.
He won.